So we finished the week on a little bit of a high note. And the question is now, how high of a note was it? How strong of a move was this? Are we going to get, I mentioned in my last video how the little pullback is, how it compared to the prior pullback from a couple weeks ago. Now, how is this bounce going to be compared to the last bounce? Are we going to get back up towards resistance again? And how do things different here? And now that we have expiration behind us, how's that going to impact what we can expect to see in stocks over the short term, and then what can lead going into more intermediate to long term, and what are expectations there. So I'm going to break down the difference there in the short term expectations based on what the charts are telling me, and then how that relates to my longer term expectations and how to manage and trade it with our trade idea of the day today. So let's go ahead and get started. Today is Friday, May the 15th, 2020. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, let's start off taking a look at the S&P 500 with the Market Forecast Indicator. A nice little rally the last couple of days after opening up lower both these days and then finishing higher with some open candles. So good move here. We talked about the idea between this drop that we had from the 62% Fibonacci retracement line to the 50 compared to this one. This one occurred with opening gaps to the downside that were filled in. This one did not occur with opening gaps to the downside. And you can see every opening gap since has been filled in the day of. So it's going to be interesting to see how, over here it was easy to get up. Back up to the 62%. The question now is going to be how easy is it going to be without the gaps to fill to get back up, knowing still that we have this little gap to fill in from down below. You have falling intermediate line, but at least it's still above 80, so it still has a strong bullish posture. That's why you have the dark green shading. You're above a rising moving average. That's why you have the green line. The near-term line has bounced back up. This peak here was a relatively equal, slightly lower peak than what we had. So, when you're looking at near-term lines, we've been getting progressively higher near-term highs until that one. That was the first one that wasn't, obviously a higher near-term high point. All the lows have been higher too. That near-term low, this near-term low, like not regarding this little dip there, but this near-term low, that near-term low, that near-term low. And then we got an equal near-term low that was probably slightly lower after getting a slightly higher. So, we're in a sideways little near-term trend that we need to break out of. And the fact that we are slightly, that they were getting so high and they really slowed the pace, right? I mean, this one was much higher. The low was much higher. Then it was obviously higher high, and there was obviously a higher low, and now not so obviously, pretty sideways action here. So and like I said before on Wednesday, that near-term drop was the biggest one we had. Right, you go back to this other near-term drop, this other intermediate line. We had one little near-term drop right there that barely got in the reversal zone, and actually produced light pink shading. We got another one right here that barely got in the reversal zone that also caused some light pink shading. Well, this one got a lot lower. Right, so it didn't just dip its toe in the water like these two. This one got much lower, and the question now is, will this also produce light pink shading like we saw with these two? So it hasn't yet, and remains to be seen. Again, falling intermediate line remains to be seen if this is the near-term peak, right? Where is the index going to peak? With this near-term high, that blue line getting above 50, and like this one here. So the question, that's a good question, and that's going to dictate whether or not we get light pink shading. Obviously, if we do get light pink shade, if we fill in this gap, you will get light pink shading more than likely, because it will cause a move to the downside, and since it's below the moving average, it will also cause a yellow line. If we close down there, it will also cause a yellow line. So I actually wouldn't be surprised if that's what we got over here. We didn't get the yellow line here because it didn't quite get below the moving average, but we'll see if that kind of pattern ends up forming here, where we get light pink shading and a yellow line again on the S&P. Again, I would imagine if that were to occur, it will probably occur post expiration. Like you can see, we got some weakness here. You got a day of of weakness there after expiration. You got about a week of weakness here after expiration. You got about a week of weakness there after expiration. You were kind of volatile after a bullish move. You were pretty volatile there. You had some weakness here. So, considering that we have expiration today, the past pattern has been to have a day, a few days up to a week of weakness coming out of this expiration. So we'll see if that ends up being the case, and if we end up filling in that gap at the I think that would be our best case scenario is, that we get any kind of weakness here that only lasts maybe a day like this and fills in that gap. Otherwise, if we get like a week or a few days of weakness, we'll probably get to this line. If not, further, if things get, that, and this would be my worst case scenario, as I mentioned before, getting down and filling in that gap. And I think it's going to be less likely we fill in this one. And if we do, we're not just consolidating anymore. If we break down into this gap, we're trending lower again. We're going to be in a bear. In that particular case, I think this would be our failure at the 200-day moving average. You'll see here in a second, and we would be in a bear market. I don't think we're headed to a bear market. I think we'll just kind of stall in this Fibonacci retracement area for a while. Maybe, in the best case scenario, maybe getting up above into the 78% level, getting up into that area, because that's the Qs already have. But in the worst case, over here. But on the other hand, like I said, the Qs have broken out, and you can see, they didn't have the greatest day today. There we go. They didn't have the greatest day today, but they rallied at the end of the day, and they're strong. And we've talked before about them. This has broken through. There we go. It's broken through its 78% level, and after pulling back on Wednesday, it's gotten right back up above it today. So that's a positive development for the Qs. But the issue is, and what could end up happening is you get a retracement here. So let me move this line. Sorry, let me activate this and move this. We'll move this up here to the top, and then we'll move this one down here to the bottom. So if we do get any weakness in the short term, kind of post expiration, watch for this to come down more, because this one didn't, more towards the 23%. And if it ends up being more of like a week's worth, and we fall down to the 38% Fibonacci retracement on the S&P, then pretty good chance we fall to the 38% retracement here, which would be a retracement because we'd be breaking the 23% level, we'd be hitting support, and that's kind of where that's where I would look for some support on the index before we take off and rally back up again. So that's kind of my expectations. I know it's pretty specific in detail, but that's kind of what I'm watching for on the markets and the S&P. If you take a look at the Russell, this nice little long lower shadow at the moving average, light pink shading, mind you, and almost got a yellow line there, but a long lower shadow. It's relatively bullish. The intermediate line still falling. We did get, this was more obviously a lower high and a lower low on the Russell 2000. If we're going to be bullish here, we need this to be a flag pattern. So this kind of a flag pattern is where you have a parallel set of a channel here. The consolidation forms the consolidation forms like a parallel channel, and then we break out of that channel in the same direction you had going into it. So that would be a flag. That would be bullish. It would need to break above the 50%, and we'd feel pretty good about that. Otherwise, if we get any weakness there, then look for us to come down towards this 1140 area, to that level. And again, that would more than likely coincide with the S&P breaking to the 38%, the Qs getting a retracement down to its support levels, and then we rally. And so that's the kind of post-expiration weakness pattern that I can see us forming here over the next few days or so. It wouldn't be earth-shattering. It wouldn't be, all of a sudden now we're doom and gloom. The market might take it that way. The media might take it that way. But it wouldn't. It would just be space filling, so to speak, and nothing necessarily more than that. We wouldn't be re-engaging a bearish trend at all. All right, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over the subscribe button right here and hit that red subscribe button that pops out. There's also a button, if you're watching us on YouTube, down below. That will notify you when these videos are posted. Hit the thumbs up icon that's down below the video. That tells us two things. Number one, you liked our video today. And number two, you want us to do another one on Monday. So it's a quick way to give us feedback, and it's our survey. It's what we, it's what we look at to see if you like our videos or not. And like I said, if you like our videos and you want to let us know, click that thumbs up icon right now. If you don't have to. Right, if you don't like our videos. Again, comment also down below on anything that stands out to you. What questions or comments do you have about what I talk about in the video, or anything I didn't talk about that relates to what we're covering here in these market outlooks. Join our website at marketscholars.com. There's a link popping out right there in the top right corner of your screen. Click on that link. It takes you to a page where you can subscribe to our site for free. Follow me on Twitter for more content in between the videos from day to day at DavidSettle42, and join our Market Outlook Facebook group that we've created. All right, if you're watching us on our website here, we invite you to check out some of these other things, our classes, our Market Outlook Live trade review videos that are so commonly asked for. You can check out the trade idea I do in today's video before the market closes. We do these at 3:30 Eastern time every time I do the market outlooks. You can also see here we have we invite you to engage with us on social media. Hit this heart, it opens up this new window, and hit that like button right there. Hit the thumbs up. Do the same thing on your Facebook page. Again, that benefits us because the more these posts have engagement, likes, and retweets, the more they will promote our content to all of our followers that follow these accounts. It benefits you because Twitter and Facebook will promote content in your timeline from the accounts that you engage with the most. We try to make it really easy for you to engage with us here. You can also share this blog post, with others through Facebook, Twitter, LinkedIn, as well as through email here. You can use these and share these and see how many shares we can get here over the weekend. All right, now let's take a look at the long-term chart that we have here. And you can see the S&P is kind of stalling here at the 200-day moving average, which might be another reason why we might get a little bit of short-term weakness. You can also see, too, that, for that matter, the 50-day moving average and the 200 are both inside this Fibonacci retracement zone. That's how much we've kind of tightened up here. So we can pull back down towards the 38%, and that could be a pretty significant pullback just in terms of like dropping back below the 50-day moving average. If you keep in mind, the Russell 2000 has done that, right? So the Russell 2000 has this week broken back below the 50-day moving average, even if it's just barely, if you look at the regular candle here, just barely above the 38% retracement level. You can see the difference, though. Like, its 50-day moving average is at the bottom end of the retracement, and the 200-day is just above the 62. So on the other hand, again, if you look at the index of the QQQs, then we are well up above, right? So much different chart here on this chart versus the Russell 2000. It's so dramatically different. It's unbelievable how wide of a divergence and discrepancy there is. It's not unbelievable. We've seen this before, right? This is not a unique situation. It's just not an uncommon situation, and kind of a little bit of a bubbly situation. But you can see the Russell closing back below the 50-day moving average. So, that might, again, lead us to a little bit more weakness. Again, just kind of post-options expiration weakness, maybe a week or two. I'm not looking for us to like bear market mode here. I'm just looking for us to consolidate a little bit more, and it might be down in this area for the for the Russell. It might be a little bit less. We might only get down to this 38% on the S&P, but that would be good enough pullback without things going haywire that the Qs can then lead us back up to the upside, because again, the Qs have been bullish. There is an opportunity to make a trend. I wouldn't be surprised if we get a pullback towards the 200-day moving average. Again, if I redraw these lines and bring this up here to that level and bring that back down to this level, so we can retrace this bullish move that we've had. Again, we can come down to the 38% retracement level and retest the 200-day moving average, maybe even dip a little bit below it, similar to this kind of pattern. That took 4 weeks, 4 weeks to do that. again, and that didn't change the trend, right? We had, had a good bullish move to get to that point. That just dipped a little bit there and touched us. So very well could get, and you're getting a little bit. That was a little bit of a bearish candlestick pattern. This has the beginnings of a bearish pattern. Again, I anticipate post expiration weakness, but I don't anticipate trend changing. This was hardly trend changing. Now, it might have been pretty bad, like, there might have been a little bit of an uproar. There might have been a markets in turmoil even during this drop, because that's 4 weeks of declines. But it wasn't earth-shattering, and I don't expect any move down towards 83.60 to be earth-shattering either. Enough, though, that we can bounce off of it and get a good run, whether it's that kind of move or eventually that kind of move. I actually think this kind of run is likely actually going into, again, very similar to the 98 period where we had a pretty significant pullback in 98, and instead of the NDX pulling back down to its performance versus the Russell, that gap in performance actually increased during the pullback, and then increased even more in the parabolic move into 99. And I actually wouldn't be surprised if we get a very similar pattern coming up here, simply because of this coronavirus bug instead of the Y2K bug. All right, let's take a look at the 3 green arrow chart for the S&P 500. We don't have green arrows yet. You can see the MACD is showing a red arrow because the MACD is still below its moving average. It'll come up here in just a second. There we go. So you can see it's still below its moving average, and its moving average is falling. And we're flirting with getting back above the 8-day here, but the MACD average is falling. The stochastics average is falling. The orange line, the blue line's a little bit more choppy, but the orange line's a smooth moving average for both these indicators. Are both falling, and they're both below their moving averages. So that weakness can persist. They might dip it's below zero a little bit here, coming out of expiration, and I wouldn't be surprised. And we could also break out, and if we break above 300, we're breaking out, and the Qs are going to be what leads us. And so that would throw all this expected post expiration weakness pattern out the window, right? But until I see something like that, that's kind of what I expect to see, and you get us a better low point, and then rally and get going again to the up for whatever the catalyst will be that will cause either the weakness or the jump back up. Let's take a look now at some of these other charts, like for example the RSI and the CCI. Again, we can't get above 60, and that's kind of what you need to get a trend going here, and we can't get above 60. The CCI actually broke below zero. And that's not a bad thing if we can get right back up above it. And you can see, remember, light pink shading on the market forecast here, light pink shading in the market forecast here. The last times we broke below it on the bullish trend, we don't have light pink shading yet on this breakdown. So that might mean that this, kind of like this bounce, it might last a little bit longer. We might fall down here. Again, if you look at the Russell 2000, you can see it got even worse, and it's barely getting above negative 100. And we're not, close to crossing above. In fact, we're getting lower highs and lower lows on these oscillators. So it kind of shows us what kind of weakness we may be seeing. Also, if you look at the Ichimoku cloud, not necessarily for the S&P, which is kind of flirting with that cloud, but the Russell, you see how it's still in the cloud. And we can come down and stay to that level right there over the next week and stay in the cloud. For the Russell 2000. If you look at the S&P again, we can come down towards the 38% over the next week and a half and still stay in the cloud. Again, wouldn't be trend changing if we're staying in the cloud. So you can see the setup and how it can happen, and it would be totally normal, and I actually think that's the higher probability setup. So it might not happen because of that, but I actually think that's the higher probability expectation coming out of this. But you can also see the bullish setup, right? Where if you break through the 62%, you break through 3,000, and here we go. And again, leading with the Qs leading, and that's going to dictate our trade idea of today. But if that's the bullish case environment, then I'm set up okay, pretty decently in our class portfolios that we use in our trading rooms for any kind of weakness here. But if we do break out, then we want to make sure that we have good, leadership that's going to lead us up and give us some outperformance on the upside. And so that's been behind some of the trades we've done, and that will continue to be. And considering that I've got a lot of negative deltas, set up on the portfolio, in our class portfolio, it opens me up to make more positive delta trades in order to provide that balance. Give those trades a longer term, because my expectations are for bullish moves are longer. My expectations for any bearish moves are short term. So any bearish trades will be really short term from that regard. All right, let's take a look at the intraday charts here. Here is SPY on an intraday chart. Nice little move up after the gap down. We filled up, closed at the high point. Again, the high and the low, the high or the low formed really early. There was, that was kind of a little iffy when we rolled over there at that high point that we might finish down here, but we didn't. We reversed and actually went up to the upside. Once Europe closed, the market went up. So keep that in mind. It's Friday afternoon. Nothing's open anymore. It's heading into a weekend. So I don't put a lot of stock into that kind of rally. It was a pretty slow day anyway, but at least we closed up with a higher high and a higher low on a day-to-day basis. We closed above yesterday's high point. So, I don't expect this to be too bullish because, like I said, there was gaps up here to fill on the rally. There's no gaps up here to fill. We filled in all gaps. So, as bullish as we can be with expectations of being bear, that's about as bullish of a close as we could get. The problem is how likely that is to persist going into early next week if we don't come back down, like I said, and finish filling in the rest of that gap right there over the next few days. And the other sign that we could have some bearishness is the low tag and the high tag are gradually moving to the left. When they're both over here on the left, that means we've gone that's a reversal sign of the trend you had going into it. So we've had a bullish trend going into it. We've gone so sideways that they're now moving to the left. I would expect a little bit of a reversal. So in other words, the high tag to stay over here and the low tag to form over here. So we'll see. We'll see if that ends up happening. Let's take a look at today's volume and trading range. You can see the volume, it was just a little bit below average, 111 million. A little bit of a pickup in volume here. Today's trading range was not a pickup. Like, we had a pretty decent range yesterday, 12 points, 8 points, 12 points. Today's range, 5 points. Very, very small range. So again, another reason why it was kind of a boring day and not to put a lot of stock into this rally. Very small moves, slow move, boring move, grinding move, below the average. We'll see, what kind. If we are going to have any kind of moves coming out of this, expect bigger moves. It's about average, around this 3% level, around this average. Those are the kind of down moves I would expect if we were to get them coming out with a little bit above average on the volume. Keep in mind too, the other thing that kind of stood out to me was after these kind of relatively larger opening gaps we had. Here we go. The last 2 days, about 1 standard deviation, so pretty significant. And you can see the volatility, the implied volatility, had jumped back up above the historical volatility. So something similar to this, right? Something similar to this. That can happen here. You get a jump up in volatility, and that drags historical volatility up. You can see a jump up in volatility. It drags historical volatility up until it outpaces, and that usually signals the end of the volatility. So right now it looks like volatility may be in the mode of dragging historical volatility up. And, we had a couple big down moves, and that's all we got in response. So not exactly the most, even with it's at least we didn't get big declines. But again, when we had this downward move here, we had relatively big declines, but with big gaps. And so that made up most of the declines. Here we have big gaps to the downside, and we have big up days. So that's a little bit of a little red flag that we want to see. That's again tells us to not put a whole lot of stock in this bullishness, this week ending bullishness here. Finally, here's the VIX. The VIX did pull back, did not get back below 30, but it did pull back into the neutral zone, back towards the lower end of the neutral zone, back again towards a spot that it can jump off of, right? And we had bullish days in volatility, and they're typically followed by down days, and we've had a couple of those, but we didn't fall back down very fast. So now the question is, are we going to bounce off of this support again and make a run back up towards 100, if not 105%? and that would probably coincide with a run back up towards 40. So those are things to kind of keep an eye on in the next week or two. And if we did, and if we get a good, we haven't had, this is about as bullish of a week volatility that we've had, but even then it was a long upper shadow. We still haven't had a good bullish candle that we can then now turn back down from for so many weeks in a row. You can see so many weeks in a row you get with lower volatility. So we're still kind of in the mode of falling down, but you notice how we can come back up to 40 and not really skip a beat in terms of changing this downward direction. It would just be kind of a breather, like it would be kind of a reversal, a short-term reversal on this longer-term pullback, decline in volatility that you'd expect to see. Something like this, right? You have this short decline, you pop up into this range, and then you continue to decline down here. That's kind of the expectation I'm looking for. If you go back, as a lot of people have, towards that 2008 to 2009 period in volatility, and go back to a weekly chart again to show what it looked like back over here. So here's a decline, and during the decline in November into December, there's that bounce up. Well, I don't think we're getting that kind of drop, but here's the drop at the beginning of the year. We were on a steady decline down below 40. Then we just had a couple of up weeks. It just filled in the range. It didn't go up to new highs, but just kind of filled in the range, and then we continued down. So if we get, and again, any kind of post-expiration weakness, I expect it to look something like this, coming out of a downward trend that we're currently on right now. So to summarize our technical outlook here, the trend has been bullish. It's been slowing. It's slowing to the point of, especially going into an expiration Friday, slowing to a point that we can get some short-term weakness over the next, day to week or two. I anticipate more likely like a week or two of weakness coming out of options expiration. On the other hand, again, a break above 300 would nullify that. That would be I think that's a low probability scenario, but one that you can't dismiss completely, and we'll be prepared for something like that to occur. But we're also prepared too for any kind of weakness that we have, any kind of consolidation, and I don't think it would be significant. I think it's just going to be short term, but that's what a lot of these indicators are suggesting and pointing towards. So what do you think? Do you agree with that assessment? Do you disagree? There's a link popping out right there, top right corner of your screen. Click on that link. It opens up a poll, and hit either agree or disagree. And then down below, comment as to why. Why do you agree? What are you seeing? Why do you disagree? What are you seeing? And let's see what everybody's thoughts is, and let's keep this conversation going in the comment section. All right, now let's take a look at what's driving the price action here this week, and you can see what really caused some this late week increase in risk appetite. Wasn't a drop in gold. It wasn't a drop in bonds, because bonds actually rallied here. They ended up holding up, but you see the rally in crude oil. Crude oil really took off like a rocket ship to the upside, and gold ended up being up for the week. The dollar ended up for the week. So gold didn't rally because the dollar dropped. Even the dollar ended up for the week. It was just a move towards safe havens throughout the week, and even at the end, even with an increase here. You can see the gap between the S&P and the Russell during this pullback here. The gap got bigger. It was the Russell that was falling, and the Q is holding up. And you can see now, the last couple of days, the Russell's rallied more because it's been so oversold. It's rallied more. Real estate, on the other hand, not popping up, and you can see international stocks lagging. They were outperforming pretty significantly the S&P 500 here up to a point, but then that gap in performance, it didn't reverse, but it evaporated with the S&P climbing through and outgaining these international areas by the end. Let's take a look at the week that was in the dollar, and let's see if they haven't changed that error they have there. So we have to take a look at the UUP, the ETF that tracks the dollar index, and you can see it had a pretty positive week. Not the most bullish week, but bullish enough to maintain the bullish trend that it has, and it wasn't a bearish. This is a Hakinashi candles, right? So you can see a reversal to a bearish bullish candle. We'll see if that ends up just being a one-off week, though. It's as last time we had that, we turned right back to being bearish, but without really significant closes, at least on the Hakinyashi candles, below this rising 50-day moving average. Take a look. We talked about this increase in crude oil. Well, look at that candle. I mean, that's a really bullish candle. Now, again, we were well below the 50-day moving average, but if you look at the regular candle, we closed above the 50-day moving average. That's a really bullish close after getting that long lower shadow. Really bullish close coming in here to being above the 50. So again, when you got a really strong gap in the PPO as low as it is, and you break above the 50, you typically start working your way back up to you fill in the gap towards the 200. So we'll see if that ends up being the case. Otherwise, it might be a one-off thing too here, where you were so far down below, you rallied up, you got through, and then we came right back down. If that ends up being the case, then again, look for some weakness in the short term. Otherwise, crude oil might kind of show us that we might be moving up for a while. In the case of crude, at least up to its own resistance level, similar to the Russell 2000, right? You look at the 10-year note, and the 10-year note's not. So, again, it's the yields and the crude oil have not been able to kind of match what these equities have been doing, especially the Qs, not so much the Russell. But at least crude oil kind of joined the party, similar to what the Russell has done. But we're not seeing that in the yield. The yields just cannot get going. And, up a little today, up 2 basis points. So we got up to, 64 basis points instead of 62. But still, it's a concern that you can't get up and get going on this. And if you take a look at its Hakinyashi candlestick pattern here, you can see it's, you've got some transitions that could lead to some bullish. So we'll see how things end up next week. We are at 6.4 now, and that's about where we are. That's about where the Hakinyashi Open is going to be. It's actually going to be a little bit below the Hakinyashi Open. So, we're going to be some kind of transition candle next week too, until we get some kind of bullish move. Let's take a look at the global markets, because that's been an interesting pattern to see all the different shades of pink and red. Well, so Italy now has dark pink shading and a red line. Brazil has dark pink shading and a red line. The UK, France, Germany all have light pink shadings and yellow lines, and they're below the moving averages, and they're just barely rising. Really, the only markets that have been doing halfway decent have been the Asian markets. You have China, you have South Korea have pulled back towards moving averages. Japan. China has actually pulled below it slightly, giving you a yellow line there too. So lots of light pink shading. The only green shading right now is the U.S. market. So again, kind of standing out here. It's done this before where it kind of stands out for a while. The question is now, is it going to continue to stand out, or are we going to, if we're going to bounce, we would like to see a kind of broad bounce in all these different areas, coming off these moving averages and yellow lines and light pink shading patterns, and bounce up off of this. Otherwise, if we roll over like Italy and like Brazil, then we're back to having relatively bearish patterns. And France is already close to crossing below 50. UK is getting there, and then Germany's there, down below 70 now. So, if we get some more weakness again, we might get some consolidation for a few weeks. If you take a look, today's economic calendar had quite a few things on there. The Empire State Manufacturing Survey didn't get a whole lot of press early, but it was still a really pretty negative number. They're at negative 48.5. It just beat the estimates, right, and up much further than the prior figure. The retail sales number is the one that got all the press earlier this morning. Give it a second here to load up. You can see the year-over-year or the month-over-month change, all double digits. And, they weren't so hot last month either, but now they are significantly double-digit returns. So, a lot of times you see this, you just bounce right back up. So we'll see if, we bounce up off of this and continue higher. Industrial production is another thing you can look at on the year-over-year level. Not showing the year-over-year figures here. But you can see the month-over-month changes are pretty significant to the downside, to the point where the economic surprise index is coming back down to negative 95. So very, very low levels. And this measures, again, how we're doing relative to estimates. So we're still coming down well below the estimates. On a global basis, we're down to negative 121. Again, that's kind of like recession low points for these indicators. So we'll see. The issue is we had long-term bear markets that culminated with these moves. The end of 2008. We're not. We haven't been in a long-term death cross. Globally, we have, but not here in the U.S. So we'll see. If this ends up being enough of a drop, and we've had enough weakness that we can turn into a long-term bull market off of these extreme lows in these economic indicators. It looks like, from an economic standpoint, when you see these drastic numbers, it looks like the end of a bear market. It looks like the end of a recession. That's when these numbers really get the worst, right? I think we think, because we're so binary, that if we're going to be negative, it's got to be hugely negative, and we're either really positive or really negative. And the reality is, when recessions start, those year-over-year figures, they're starting to roll over. And they get less positive, they cross over the negative, and they gradually move down. And then you have the big blowout at the end, right, where liquidity dries up, and it's kind of like the last flush, and then the stock market rolls over, then eventually the economy rolls up, and we get going. Well, here we didn't have like a gradual decline. We were going up, and we've had a big flush to start a recession, if we do end up in a recession. And that's not necessarily, 1987 maybe, but that was more of a stock market issue. So we haven't seen a recession start off with a huge bang. It usually ends with a huge bang. And then we turn, the stock market comes up and everything comes out of it. So we'll see how that turns out and what kind of impact that has on long-term return expectations coming out of it. But from a short term, when you get these really extreme numbers, even short-term returns tend to be pretty good because, again, it's like a flush. How much worse can these economic indicators get? You already seen the Empire State Manufacturing's starting to get less negative than what it was originally, at its last reading. All right, so now let's take a look at how the sectors have done this week. And you can see going into the week, we had weakness in industrials, weakness in financials, weakness in energy, but crude oil started to make a run, and so energy a little bit of a run until the very end of the session here. So that was the first kind of 3 days. Materials down as well. Remember, the dollar was up. And then you had, healthcare holding up. You had the safe havens, and technology is kind of a new safe haven was holding up. That was the last 3 days. So if I go to now just these last 2 days that we started off down and then we rallied up, we'll look at what's led us up. And you can see it's discretionary, communication services, energy a little bit into that last drop to the downside, materials as well. And the dollar didn't really fall sharply. And then healthcare lagging. You can see industrials did not do very well because of, again, another late decline here. And financials were doing really great right off the bat, right? It was financials and energy. Financials did really well right up to there. And then it didn't go anywhere the rest of the time. Energy kind of made its last hurrah here early this morning, and then it pulled back. And then you can see the gradual move higher and everything else, and the lagging behind on technology and staples, interestingly enough. And then industrials lagged for most of this period and then lagged at the end. So, again, not exactly the most bullish, even this little rally. That's another reason why I just don't put a whole lot of stock into this late push these last couple of days. If you take a look at the 12 grid for the sector returns, again, you got some dark green shading, dark green lines, just like the market here, but everything else isn't necessarily. Healthcare too, but you can see financials and industrials, dark green, dark pink shading. They're below their moving averages. Utilities and real estate too, dropping down there. You can see energy, materials, light pink shading and falling back towards their moving average. Staples has gone through its moving average. So this is not necessarily the most bullish pattern here when we've only got a handful of sectors that are showing really good bullish patterns like the market, and everything else isn't. All right, so with that said, let's take a look at our trade idea of the day. And as I said before, I got plenty of opportunity. If the market does pull back as expected in the short term, then we're fine in our class portfolios that we use in our trading rooms. But if it breaks out, then we want to be able to take advantage. And of course, we know the leadership involved in any kind of breakout. And so that's I'm taking advantage of a strong move in that area. In this talk in particular, Sienna bouncing up really sharply here today, going into options expiration. Nice, strong, solid move. We had a cluster here at the beginning of this intermediate run, and now we've, after the pullback, kind of broken back out after that cluster. A lot of times you get the cluster early, which is a good sign for continued trend, but then after the cluster, it makes a little bit of a pullback. Let's see if we can find an example on here. Well, here's an example here. So you get the cluster, you pull back, and once you get above the cluster, then it makes the run that you expected. Well, when you're at the beginning of an intermediate run. And so that's kind of the idea here. Beginning of the intermediate run, cluster, pull back a little bit, and now we're breaking back out again. And so an opportunity for this stock to make a decent run to the upside. If you take a look at it, MACD and stochastics, they're both strong. They're crossing over their moving averages. The stock itself had opened up below the 17-day moving average, but then rallied pretty sharply above the 8. The stochastics tells you got some room to run there from a long-term chart perspective. You'll see that we got a golden cross. We're getting strong bullish candles, higher high, higher close. Very, very small lower shadow. We have earnings coming up here. Take a look at some of these other oscillators here. The RSI getting above 60. The CCI getting above 100. It's already done the break above 200. So that was on the cluster when we got that. So feeling pretty strong about that. You look at its DMI, and you see it's got a good bullish pattern here too. See, unlike these others where the bullish move occurred early on the earnings, and you had the biggest move early, and then we went sideways. I mean, that's more of a bearish sign. When you get, usually you start bearish runs with a spike. Here you started a bullish one with a spike, and we didn't get much of a bullish run. Here you started a bullish run with a spike, didn't get much of a bullish run. Here you're not starting the bullish run with a spike. It's been more gradual, and that's what you expect, and it usually leads to a spike by the time we're done. And getting back above 30 and being below 20 is a good pattern there on the DMI. From an Ichimoku trend standpoint, in Ichimoku Cloud, you can see we had dropped below the green line. We had been below the green line after the cluster for quite a while, but still above the blue. And now just bounced right off of that. Very strong trend, above 80, above 90 on the daily chart. You can see the weekly chart is getting to a moderate trend strength. This is kind of the ideal scenario, is you get that kind of run on a weekly basis there. From a Bollinger Band perspective, you can see that we are breaking above the upper band, and we're breaking out. We're not breaking above the Keltner channel because that was, if you look at the Keltners here, let's see if I can bring it up over here. Here's what I want to show you. So you got the Bollinger Band here. Let's pull up Sienna. You got the Bollinger Bands inside of the Keltners, and then you're getting a breakout here. And so that the idea is now the Bollinger Bands can push outside of the Keltner channels with increased volatility, with a lower bandwidth that you'd expect to rise higher. So that's kind of the expectation that I'm looking for is we can get a pretty decent move if the market rallies, right? Especially in considering that we can make this a longer term trade. So if we get some short term weakness, no big deal, right? That's the benefit of time in these long calls is if we get a little short term weakness, great. If we don't, if it continues to rally as the chart would suggest, then we've got something that we can be able to make money with in a leadership area in the markets here in this tech networking type of area here. And that brings us to our trade. And what I'm going to do is I'm going to go out of the money so that way I don't have to use a stop order and I can position size around the full maximum loss. I'm going to buy the 55 in July. So that gives me some time to work with. And if we get closer to July and we're still in a bullish trend, I can roll it. Continue to roll it here. You can see I can keep my risk to a normal risk. Even with the earnings coming up, that's the other reason why I went out of the money. With the earnings coming up, if it is really negative, then I can get out at 50% pretty easily on this, depending upon how far down we fall. But I can get out at 50% easy, but if it breaks out to the upside, then we've got good return potential. And like I said, we can continue to roll it if it continues a trend, if it gets into that trend strength on the weekly chart where we last in weeks, right? And again, that's kind of my expectation is, I think this tech bubble, I don't think it's so bubbly that we have to, it has to burst and we're going to fall off a cliff right now. That didn't happen in 99, 2000. It took multiple years for that bubble to burst. But it also took, coming off of that 98 low point, if you're looking at this low, similar to that 98 low point, we had about 18 months of that bubble continuing to form. So this depends on how long we pull forward all this tech spending and all this tech potential, and with this building out the stay-at-home economy now, or work-from-home economy, where more people work from home and needing the technology available to do that. All right, so that wraps us up for today. You've heard from me now, and now I want to hear from you. Use that link that's popping out right there in the top right corner of your screen. It takes you to our Market Outlook forums. Open up any new thread and reply to other people's threads with any questions or comments you have about what we discussed in this video, or about, with anything we didn't discuss that pertains to this topic. Let's keep this conversation going over the weekend until our next video here. Again, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, and comment on our video down below. Follow me on Twitter at DavidSettle42 for more content in between these videos, and join our Market Outlook Facebook group that we've created, as well as our website at marketscholars.com. Have a great rest of your weekend, everybody, and we'll see you all next time.